Well, let's step through the minutes from the last Fed meeting, and I've highlighted quite a bit, maybe a little more than I need to, but I think it's important that we, in our ears, can hear what they were talking about in that meeting so that we have a better idea of what we think we can expect going forward. Interesting, it starts off with committee ethics discussion. A little paragraph at the beginning say, hey, I think it's important we be ethical, right? Does everyone agree? Can I get everybody's head nod? Good, let's move on. But here it is there. The chair began with a discussion of ethical standards, acknowledged the great privilege and heavy responsibility that come with being entrusted to make policy decisions. That's because of some of the missteps of some of the members, whether they intentionally or unintentionally did something or just simply not disclosed it when it was really nothing, but they should have disclosed it. I just find that interesting. Okay, let's begin. We're starting with the developments in financial markets and open market operations. With data received over the period also indicating higher than expected core inflation, market participants placed high odds on a 75 basis point increase in the target range at the current meeting. And we know that happened. Nonetheless, contacts, and this I find interesting, this next sentence here, nonetheless, contacts were increasingly focused on the question of when the committee might slow the pace of future increases in light of the substantial tightening of financial conditions that occurred over the year. Most respondents to the open market desk survey viewed a 50 basis point increase in the target range for the federal funds rate at the December meeting as the most likely outcome. So they're acknowledging that, we'd be moving fast, and people are a little concerned that we're moving fast, and there's an expectation of 50 at December. Let's see what we can get done. And as we read through this, we'll find that they're finding more reasons why 50 makes more sense. So from reading this, I pretty much think 50 is a lock. I don't see in these words, in these minutes, a willingness to go 75 in December. Even though they hadn't seen the lower inflation reading yet, I still don't see the willingness to go 75 in December. I think 50 was a lock even before the lower inflation reading, which makes 50 pretty much a sure thing at this point. What else have we got? Elevated volatility in international financial markets contributed to volatility in U.S. core fixed income markets. In markets for U.S. Treasury securities, some measures of market implied volatility approached pandemic-era levels. Spreads on yields on agency mortgage-backed securities over yields on Treasury securities widened sharply, reflecting the sensitivity of these spreads to increased volatility. And yes, we know that happened because if we look at the performance of mortgage REITs up to or over the intermediate period time from September to November, most mortgage REITs sold off really hard. The increased volatility appeared to contribute to a decline in measures of market liquidity in core fixed income markets, in particular around the period associated with UK volatility, but market functioning remained orderly. Okay. Usage of the overnight reverse repurchase agreement facility remains steady, or fairly steady, other than during the period surrounding quarter end. And it's still elevated. I think the highest amount overnight was 2.4 trillion, sitting somewhere around 2.1 trillion now. And that's because there simply just is a shortage of T-bills to buy. This facility is contributing to the losses that the Federal Reserve System is incurring right now. Same with the Bank of Canada. The Bank of Canada is showing losses now. And we'll see later on how they're dealing with their losses. Recent developments, including with regard to the relationship between the reverse repo facility balances and money market rates, suggested that over time, conditions could evolve in a manner that would lead to falling usage of the reverse repo facility. And if it does, well, their interest expense would go down. So they have a whole bunch of bonds on their balance sheet that they got at very low yields, so they have low coupons. However, this 2.4 trillion in overnight reverse repos comes with a very high rate, the lower range of the federal funds rate. So their interest expense now exceeds their interest income. So this dropping over time can only benefit them. So if they allow T-bills to run off and they're not rebuying those T-bills, remember they have 60 billion in treasuries that run off each month. If you don't have any coupon paying bonds, they let the bills run off. The more they let that run off, the less and less pressure there is for banks to use the reverse repurchase facility, and the lower the interest expense of the central bank will be. Let's see. In offshore dollar funding markets, the premium associated with borrowing dollars was modestly higher than at similar points in previous years. That's pointing to a shortage of US dollars internationally, because dollars are needed to settle contracts and dollars are needed to make coupon payments for bonds that are countries that are holding US dollar bonds or have issued US dollar bonds. They need US dollars to make the coupon payments, US dollars to make principal payments, and some imports of a product, food product, energy product, are primarily conducted in US dollars. And when you have a central bank that is pulling dollars from the system, well, that increases the specialness of those dollars, right? Regarding Federal Reserve net income, 11 reserve banks reported deferred assets totaling $6.3 billion in the latest H.4.1 statistical release, reflecting the negative net income stemming from rising interest expense. Many other central banks also faced negative net income, Bank of Canada being one of them. So what is a deferred asset? This is where you have a loss. You don't know where to put it, but you know that it's going to resolve itself over time. You're just looking at your cash flows, you're projecting it out, you're saying, well, this will fix itself over time. We know it will. So why don't we not call it a loss now? Let's call it a deferred asset. And the deferred asset is just the present value of all of these interest payments that we're going to have that show what our what it'll eventually amount to be. This way here we don't have to print a negative equity amount. Staff review of the economic situation is next. The information available at the time of the November 1st-2nd meeting suggests that U.S. real gross domestic product had increased at a moderate pace in the third quarter. After having declined over the first half of the year, labor market conditions remain quite tight, consumer price inflation. And it's important to note, when they say consumer price inflation as measured by the 12-month percentage change in the price index for personal consumption expenditure, that's PCE, not CPI, remained elevated. Private sector job opening rate, as measured by the Job Opening and Labor Turnover Survey, that's the JOLTS survey, moved lower on net from July to September, but remained high. Nominal wage growth continued to be rapid. Average hourly earnings rose 5% over the 12 months ending in September, while the employment cost index of hourly compensation in the private sector, which also includes benefits costs, rose 5.2% over this period. And we had, in previous videos, made the distinction between average hourly earnings and the employment cost index. The 3-month change in the ECI in September was noticeably lower than the average pace seen over the first half of the year. So going into this November meeting, where they all agreed to go 75 basis points, they were already in possession of this information and already acknowledged this information, but still went 75. Consumer price inflation remained elevated. The trimmed mean measure of 12-month PCE price inflation constructed by the Federal Reserve Bank of Dallas was 4.7% in September. I highlight these things because it gives us an idea of what they're looking at, so we can start looking at these things too, or make sure that we continue to look at this because they're looking at this. And if they're looking at these things, this is the data that they're dependent upon. So we will get the data as it comes out, and we'll have all of this data before the Fed meeting, so we'll know what data their decision is dependent upon. So they have mentioned a couple of things here: average hourly earnings, the employment cost index, the trimmed mean, the Dallas trimmed mean. They're looking at the JOLT survey, and up here, the PCE price index. Okay, next, top of the page here. Data pointed to weakening foreign economic activity in recent months, weighed down by the economic fallout of Russia's war against Ukraine. That's still going on. Headwinds in China, and they've actually gotten a little bit worse because we're seeing COVID cases start to hit the same levels they hit earlier in the year, even exceeding those levels. And we are seeing some lockdowns starting to happen. So that's actually gotten worse since the November meeting. And tighter financial conditions, well, they're now looser. We can't say that they're tighter. Oops, I think I jumped ahead here a little too much. There we go. In many advanced foreign economies, high inflation and disruptions to energy supply contributed to a decline in real disposable incomes and depressed consumer and business confidence. So this is sort of highlighting to us something important as well, is that we end up being so domestically focused or U.S. focused that we forget there's a whole world out there. And we're looking at U.S. data, but perhaps we should also include in our analysis each week a look at what's going on in other parts of the world, because if there are recessions in other parts of the world, that is going to affect the demand for U.S. goods and probably affect the growth rates in the U.S. I can't see why it wouldn't, right? In China, data indicated weaker momentum in economic activity and a further deterioration in the property market. Weaker global demand has also resulted in a pronounced slowdown in manufacturing, which weighed on activity in export-oriented emerging market economies in Asia. Let's move on to the review of the financial situation. This was the review of the economic situation. Now we're going to look at the financial situation. That's the game we play. Over the intermeeting period, U.S. Treasury yields and the market-implied federal funds rate path moved substantially higher. The rise in borrowing costs appear to have slowed the volume of financing in many credit markets. Credit quality remains sound overall, although there are some signs of deterioration for lower-rated borrowers. The expected path of the federal funds rate, implied by a straight read of financial market quotes, rose notably over the intermediate period, largely reflecting more restrictive than expected monetary policy communications and data releases that pointed to inflation moving down more slowly than previously expected. So when they're talking about straight read of financial market quotes, you can get this directly from the Fed funds rate, Fed funds futures, which we look at each week to see where it's peaking and what the terminal rate is at the end of, I think now we're no longer doing 2022 because there's only one more meeting, looking at 2023, and we're seeing that it is higher. After this meeting, it ended up being higher and pushed out further. Before the meeting, even in September, early September, we had March or April peaking somewhere around 4.5, 4.6. Now we're sitting somewhere in July peaking at 5%. Bond equity I had to stop and say bond equity. Broad equity price indexes fell significantly. However, equity prices later rebounded and ended the period essentially unchanged on net. A 1-month option-implied volatility on the S&P 500, the VIX, declined slightly on net but remained at the upper end of its range since the mid-2020. And VIX, as of now, as I'm reading these minutes, VIX is sitting down around the 20 mark, which is the lowest it's been in quite some time on the VIX index. And we have an S&P that is higher now than it was at this period of time when the meeting occurred. And we're sitting over 4,000. It seems to be kind of supported there. However, this was a very short week on very light volume. Can't read too much into this right now. Let's see. Conditions in short-term funding markets remained stable over the intermeeting period. Foreign asset prices were volatile over the intermeeting period as investors grappled with a combination of a deteriorating global growth outlook and synchronous policy tightening undertaken by major central banks in response to high inflation. U.S. dollar appreciated against most major currencies, driven by widening yield differentials between the United States and the rest of the world and further deterioration of foreign growth outlooks. And the U.S. dollar had peaked. It has been retreating for some time now because this meeting, we're going to see a little later on some of the language in the minutes here, point to this as well, that there is the expectation that they're going to go 50 in December and they're going to slow this down to get to a level where they're going to be on hold for a period of time while other banks are still increasing. So those interest rate differentials will start to narrow, and that's taking pressure off, or at least removing the upward pressure on the US dollar. The Chinese renminbi depreciated significantly against the dollar as continuation of the zero COVID policy and increased investor concerns about longer-term growth prospects weighed on the economy. That has not gone away, and in fact, that's gotten worse. Investors continue to withdraw from dedicated emerging market economy and European funds amid further increases in U.S. Treasury yields and concerns over foreign economic growth. So they are acknowledging that U.S. Treasury yields are giving a level of competition to other assets. That why should I be in these risky assets when I can get on a 2-year 4.5% on a 2-year in US dollars and just sit out the next year? We have heavy inversion of the yield curve in Canada, in Germany, in the US. You have lockdown starting in China again, which is probably going to lower global growth and may exacerbate supply channel issues, and there goes inflation all over again. Why? Why risk it? So they are acknowledging that the high yields are giving some competition to other risky assets. Yields for corporate bonds, now they're talking about yields, not spreads here, because spreads have held up fairly well. Yields for corporate bonds, and the yields for corporate bonds are being primarily driven by the increase in yields on treasuries. Because over the past 3-4 months, as we've been looking at the OAS on all the credit qualities, they're not really budging that much. Yields for corporate bonds and institutional leveraged loans increased. Bank interest rates for commercial and industrial loans continued the upward trend observed since the first quarter of 2022. Municipal bond yields increased across rating categories. Residential mortgages rates rose further. Now with residential mortgage rates, you have two things going on. You have the increase in the spread against the 10-year and the increase in the 10-year. So mortgage rates really moved a lot. Interest rates on existing credit card accounts continue to trend upward, reflecting increases in the federal funds rate that were quickly passed through to prime rates. You would think that all of these things are leading to some deterioration in credit, the credit quality of the people who have these, increased defaults, etc. But we'll see that that's just not the case. Credit continued to be generally available to businesses and households despite some signs of tightening lending standards in certain segments, but high borrowing costs reduced the demand for credit in many markets. There is a survey that is done, we'll see it noted down here, that we can read. It's quarterly, but it is a survey of senior loan officers where we get this information from, where questions are asked like, are you giving more loans of this type? Are you seeing more demand for this type? How likely are you to make loans to people with credit scores in between this range versus this range, that kind of stuff. It's really interesting stuff. Business loans at banks continue to expand in September, but at a slower pace than observed in the past months. The important thing here is business loans continue to expand. It's at a slower pace, but it continued to expand. This is consistent with being in the slowdown phase of an economy. In the slowdown, you're not contracting. Growth is still occurring, but it's slowing down. This is in the October Senior Loan Officer Opinion Survey. You can, if you want to find this is done by the Federal Reserve. You could just Google Senior Loan Officer Survey, and you'll find it, and just click on the most recent one. Banks reported having tightened commercial, industrial, and commercial real estate lending standards over the previous 3 months. Credit appeared to remain generally available to most small businesses. Credit remained available in the residential mortgage market for borrowers who were able to pay high interest rates. Consumer credit remained available for most borrowers in July and August, with auto credit and credit card credit. Look at this auto credit. The author here, the writer here, should have stopped and said, hang on a second, I can't use credit that many times in one sentence. But here we are. Credit card credit growing at a robust pace. Auto credit and credit card balances, or credit card credit, if you want to say it that way, growing at a robust pace. Banks in the October SLOOS reported being less likely to approve auto and credit card loans to subprime and near-prime borrowers compared with earlier this year. Well, that makes, I don't see a shock there, is that, as rates are going up, affordability of these loans become more difficult, that you would say, well, look, if you already would have had trouble affording it, you're certainly going to have trouble now. I'm less likely to lend you money based on higher interest costs. Where are we? The credit quality of non-financial corporations showed signs of deterioration in some sectors, but remained generally solid overall. The volume of corporate bond rating upgrades was roughly on par with that of downgrades in September. However, upgrades were concentrated in the investment grade segment, in the speculative grade segment, that's high yield. Downgrades outpaced upgrades, and market implied expectations of defaults over the next year increased markedly. Default rates on corporate bonds and leveraged loans rose slightly from low levels. That doesn't sound bad, right? If we're thinking about some exogenous event that could take the market down, not being taken down by its own inertia of slowing earnings, decreasing margins, earnings expectations being cut, the multiple on the market slowly working its way down. That's a slow bleed in the market over the next year. An exogenous event is something that happens which causes a cascade of things. And if we think, well, it's going to be in debt, somewhere in debt, I'm not getting that indication here. Default rates on corporate bonds and leveraged loans rose slightly from low levels. The credit quality of commercial, industrial, and real estate loans on banks' balance sheets also remained sound. Delinquency rates for commercial real estate loans in non-agency CMBS pools ticked up in September, as did indicators of future payment stress. Ticked up. Delinquency rates on small business loans remained quite low, and the credit quality of municipal securities remained strong. I'm not seeing a 2007-2008 credit crisis brewing here at all. The credit quality of most households also appeared to remain solid. Delinquencies on residential mortgage loans continued to trend down. I'm going to say that again, trend down, and the share of mortgages in foreclosure in August remained close to pre-pandemic levels. Available data through the second quarter indicated that credit card and auto credit delinquency rates continued to rise. However, delinquencies for auto loans were near their pre-pandemic levels, and those for credit cards remained well below pre-pandemic levels. Again, not seeing much here. Prices of risky assets generally fell, though real estate valuations remained elevated. And here's the thing. They're going to remain elevated. You have a structural shortage of housing. Almost every analyst I listen to that's talking about the housing market, that's the first thing that they're saying, is that we have this shortage of housing. I haven't seen an analyst calling for a significant drop in housing prices because of that. And here we are with mortgage rates way more than double what they were year over year, and housing just hasn't responded the way you think it would. If I said, what do you think would happen to housing prices if mortgage rates doubled within a 1-year period? You would think, well, housing prices would have dropped by X percent. Well, they haven't really dropped that much. Yes, they have given up in some areas, more in some and less in others, but overall, if we're looking for a 20 or 30% pullback in housing, not gonna happen. Real estate valuations remained elevated. Household borrowing was moderate, and mortgage performance remained strong. Non-financial business leverage continued to decline, and interest coverage ratios continued to increase. That's probably a driver of why we're not seeing credit spreads expand. Leverage is declining, interest coverage ratios are increasing. So if we're looking at the credit quality of these bonds on balance sheets, we would say the credit quality is good. Even if the economic situation isn't that great, this company's okay and that company's okay. In the financial sector, The results of this year's stress test demonstrated that large banks remain resilient to a substantial economic downturn, but there were indicators of elevated leverage at hedge funds and other non-bank financial institutions. Short-term funding markets continued to have structural vulnerabilities. When we say structural vulnerabilities, the short-term funding market, this is not something that is event-driven. Structural means that there is something that is persistent with it and will continue to persist. So, because it's structural, it's not like it's going to fix itself. That if something happens there, they're going to have to step in to fix that. Prime money market funds, other cash investment vehicles, open-ended mutual funds, and stablecoins all continued to be susceptible to disruptive redemptions. Okay, so there's a little corner that we really should keep our eye on, is what's going on in the short-term funding market. Okay, staff economic outlook. This one's not long, just really 2 paragraphs to look at. Then we go on to a longer section, which is the participants' view on current conditions and the economic outlook. Okay, so keep in mind that the last time we saw their summary of economic projections was the September meeting. And we will see them again in the December meeting. Every second meeting, they update their economic projections. So at this meeting, they're not updating it. They're just commenting on what they did in September. The projection for U.S. economic activity prepared by the staff for the November FOMC meeting was weaker than the September forecast. With inflation remaining stubbornly high, the staff continued to view the risks to the inflation projection as skewed to the upside. We've heard this before. For real activity, sluggish growth in private domestic spending, a deteriorating global outlook, tightening financial conditions were all seen as salient downside risks to the projection for real activity. We've seen that statement before. In addition, the possibility that a persistent reduction in inflation could require a greater than assumed amount of tightening in financial conditions was seen as another downside risk. Well, that's new. A greater than assumed amount of tightening. The staff therefore continued to judge that the risks of the baseline projection for real activity were skewed to the downside and viewed the possibility, this is an interesting statement here now, and viewed the possibility that the economy would enter a recession sometime over the next year as almost as likely as the baseline. They're putting a 50% probability on a recession. So they have their baseline case and a recession, and they're basically saying it's a coin toss. Bloomberg has a 100% probability on a recession, and most of the estimates I've seen range between 50 and 100%. I haven't seen a 20 or 30% estimate of a recession. They're all elevated. The Fed has it as a coin toss, a fair bet, 50-50. Bloomberg has it as 100%, and then you have a bunch of ranges in between. But I find it interesting that they are at 50-50 for a recession. However, they are talking about, no, we see it as 50-50, but we're still going to vote for 75. Yeah, we're looking at 50 in December. We're probably going to go higher than we assumed, that it will have a higher level than we originally assumed, and we're going to hang out there for a while, even though they're seeing a 50-50 chance of a recession, which means that they're not going to be deterred. I mean, I don't know how much more obvious it can be made here that if they're facing a 50-50 probability of recession, but they're still saying, let's go 75, another 50 in December, we're going to go higher, and the market is starting to recognize that we are going to go higher, and they did have wording before that said that it had to be higher than previously assumed. Well, they're okay with a recession occurring. So we should be prepared for them to let it happen if it shows up. That I don't know that we would expect that as soon as we start seeing some negative data showing up that they're going to run to cut rates. I don't think that's going to happen. Participants' view on current conditions in the economic outlook. With regard to the current economic activity and the near-term outlook, participants observed that although real GDP rebounded in the third quarter, recent data suggested that economic activity in the near term appeared likely to expand at a pace below its trend growth rate. Well, I don't think that's a surprising statement at all. I don't think the market's reading that going, with sucking the air out of the room on that one. Participants noted a softening in consumer and business spending growth, and we have seen that as well. When you look at the C component of GDP from Q1 to Q2 to Q3, it is lower. With inflation remaining far too high, look at the words, far too high, not elevated, far too high, and showing few signs of moderating, participants observed that a period of below-trend real GDP growth would be helpful in bringing aggregate supply and aggregate demand into better balance. So they're saying, hey, we can do interest rates. The economy slowing down and performing below trend is also doing some of the heavy lifting for us, so let it happen. Let it happen. December will be interesting because we did get not a light, but a fairly promising CPI. Let's see what happens to PCE next week. I don't expect that it will be out of line. We get one more CPI the day before the announcement. So on the day of their meeting, the day they start their meeting, because it's a 2-day meeting in December, we get CPI at 8:30 the day they start their meeting, so it will influence that particular meeting. So if it comes in, if we see that suddenly it became elevated again, 75 could be on the table again, although I think 50 is a lock. Okay, where'd we leave off here? Growth in consumer spending had softened recently. Participants observed that in aggregate, household sector balance sheets were still strong, and that this factor would continue to support consumer spending. A few participants noted that some households had been running down the additional savings they had accumulated during the pandemic, and that there were reports of a rise in the number of households experiencing financial strain. Business sector. Growth in investment spending was modest. Business investment was being weighed down by tighter financial conditions. Some business contacts indicated that their investment spending had been resilient. Easing supply bottlenecks reflected in declines in shipping costs and delivery times, although the reported extent of these improvements varied across contacts. Now this is interesting here. A couple of participants noted that drought conditions in the Midwest were making some waterways, notably the Mississippi River system, less navigable. These conditions were creating new supply constraints and putting upward pressure on transportation costs and prices for farm products. Participants observed that, with inflation elevated globally, many central banks were tightening monetary policy simultaneously, contributing to an overall tightening of global financial conditions. Participants further noted that the overall tightening of global financial conditions, along with energy prices and other headwinds, was contributing to a slowdown in the growth rate of global real GDP. Participants remarked that the foreign economic slowdown, in combination with the strong U.S. dollar, was likely to weigh on the U.S. export sector, and several participants commented that there could be wider spillovers to the U.S. economy. So I think in our weekly outlooks, we're going to have to include at least one screen that says, well, what's going on in other parts of the world? Because I think that's a correct statement, that last statement, that there are wider spillovers to the U.S. economy. So we should start to include other major economies, not all the countries of the world. Some are so small as to be meaningless. But I think some of the significant economies in the world we should begin to include in the market outlook to say, well, listen, where are they headed? Because they are a source of demand globally for things, and some of that demand comes from the U.S. Participants commented on the labor market having remained strong to date, even alongside the slowing in economic activity. A number of participants remarked that some businesses were keen to retain workers after their recent experiences of labor shortages and hiring challenges. These participants noted that this consideration had limited layoffs, even as the broader economy had softened, or that this behavior could limit layoffs if aggregate economic activity were to soften further. So this is, I think, bearish for two reasons. And no matter how you play this out, it's going to be bearish. Let's say there is no labor hoarding, and that as economic conditions weaken, you would have layoffs. That's usually what accelerates the contraction in GDP are the layoffs. Because what you're doing is you're removing or lowering the level of aggregate demand by lowering the level of aggregate incomes in the economy. But if you're going into weakness, Sorry, let me finish that thought. And if you're doing that, well, if there's less money to be spent, that means there's less revenues to be earned. If there's less revenues to be earned, there's less earnings per share. You would have downward pressure on equity prices. Well, let's say that everybody keeps their job and there are no layoffs. We still have a slowdown going on. And if that's the case, and if companies are hoarding their labor, and if labor then decides to hoard their dollars because they expect a recession, you're still going to get a drop in revenues, but not a drop in costs on the balance sheet, which means you're going to get tightening margins going on as companies say, we're not getting rid of anybody. We'll carry them through the tough time. And if you have contracting margins, well, that's negative for equity prices. If they hoard their labor, it's negative for margins, which is negative for equity prices. If they release their labor, it's negative for aggregate demand, which is negative for revenues, which is negative for equity prices. I don't see a way out of this, unfortunately. Unless you have consumer spending that increases significantly. However, how can it increase significantly when you have rates that are continually rising? You would have to have rates dropping and asset values increasing in price so that consumers feel wealthy, and that wealth effect then causes to spend a higher proportion of their current income. So no matter how I look at that, I can't find a scenario that is bullish in that statement. Both outcomes are bearish. If you release labor, that's bearish. If you hoard labor, well, it's ugly on margins, which is bearish for equity prices. Let's see, tentative signs. Lower rate of job turnover and a moderation in nominal wage growth. But let's be clear, when we say lower rate of job turnover, the quits rate is still over 4 million. Sure, it's lower than it was before, but it's still over 4 million. It's like saying the Fed balance sheet has showed some decline over time, but it's still over $8 trillion. It went from 8.4 or 8.5 trillion to 8.1 trillion, but still, come on, man. So yeah, you have a lower rate of job turnover from an extremely high level. Participants agreed that inflation was unacceptably high and was well above the committee's longer run goal of 2%. Many participants observed that price pressures had increased in the services sector. This, when I read this paragraph here, I thought that's an interesting statement to make. Many participants observed that price pressures had increased in the services sector, and that, historically, price pressures in this sector had been more persistent than those in the goods sector. Some participants noted that the recent high pace of nominal wage growth, taken together with the recent low pace of productivity growth, would, if sustained, be inconsistent with the achievement of the 2% inflation target. So you've got to do a couple of things. You've got to get wage growth down, or you've got to get productivity up. If you get productivity up, your unit costs drop, right? So if you are spending $100 to make 3 units and you find a way to make 5 units, well, suddenly your unit costs go from $33.33 down to $20. Well, that's deflationary because then you don't have to keep raising your price. But we are seeing lowered productivity. That you have all of this labor hoarding, but it's not resulting in higher real output, which means with decreasing labor productivity, that in combination with the higher wages is a double hit to inflation, because you have inflation because of the increase in wage rates, but you also have it because you have decreased productivity, which means your unit costs are getting more and more expensive. Let's see. Participants agreed that near-term inflation pressures were high, but some noted that lower commodity prices or the expected reduced pressure on goods prices due to an easing of supply constraints should contribute to lower inflation in the medium term, not in the short term, the medium term, 2 to 3 years. Several participants remarked that rent increases on new leases had been slowing in recent months, but participants also noted that it would take some time for this development to show up in PCE inflation. I wonder if that's a hint that they would be willing to look past that component in PCE. To say, okay, look, we know that these are coming down, but it's going to take some time just because of the nature of the way we measure it. It's going to take some time to work its way out, but it's going in the right direction. Can we look past this number and look at inflationary pressure and everything else but this? I wonder. Measures of medium and longer term inflation expectations appear to have remained well anchored. And then they go on to give a mini lecture of why this is important. Participants noted that longer term inflation expectations were an important influence on inflation's behavior and stressed that the committee's ongoing monetary policy tightening would be essential for ensuring that these expectations remained well anchored. Several participants expressed the concern that the longer inflation remained well above the 2% goal, the greater the risk that longer-term inflation expectations could become unanchored. Such a development, if it materialized, would make it much more costly to bring inflation down and to achieve the committee's statutory objective of maximum employment and price stability. So they're acknowledging something in this statement. Yes, higher rates will have an effect on demand. It'll hit the interest rate sensitive sectors of the economy first, and then with a lag, it'll work its way through the economy. However, there's also the expectation that we have to manage, and higher rates will work on the expectation as well. Well, where do you need the higher rates? Perhaps you have rates high enough that with time will fix inflation, however, not high enough that would fix expectations, thereby not fixing inflation. So that gives a lot more validity for them saying we need to move into really restrictive territory for two reasons. Number one is, yeah, we got to kill demand, but we don't know how badly we're going to do it. But number two, we got to make sure that expectations don't rise, because if they do, oh God, that's going to be a tough job after. This next one, I think, is just a funny line. Sometimes, and I've noticed this at academic conferences, when you get a group of overly smart people together in a room, they tend to say really obvious things in very intellectual ways, and everyone goes, oh, that's good, yeah, I recognize the truth in that still. Oh, that's really good. Wow, good contribution. Meanwhile, you know, in your head, you're saying, oh, come on, man. Like, all you're doing is saying the obvious in an intellectual way. So I think this sentence is saying something that's so bloody obvious, but saying it in such an intellectual way that it sounds deep. Whoever contributed this part, I thought, okay, good, I did my part. Like, I didn't do any of the readings before this meeting, but I contributed. A couple of participants discussed. These participants noted that the higher dispersion, well, let me read the first sentence first because it'll make a lot more sense here. A couple of participants discussed the high dispersion of longer-term inflation expectations across respondents in various surveys. You know, we just finished the sentence saying it remains well anchored, and it has to be. It's important. And a couple of participants said, yeah, you know, some people have low expectations, but some people have high expectations. The dispersion is pretty wide. These participants noted, they also noted that, hey, it's pretty wide, and we think it could be this, which is the definition of what they're saying. These participants noted that the higher dispersion may signal increased uncertainty about the inflation outlook. Well, duh, that's what dispersion is, right? The more uncertainty, the more dispersion you're going to have in your estimates. So when you see this wide dispersion in estimates, you see somebody stroking their beard going, I wonder if this could signal heightened uncertainty. You think? You think it could? Something only an intellectual could say. Okay, let's continue on after that little bit of comic relief there. Participants discussed the length of the lags in the response. Let me start that again. Participants discussed the length of the lags in the response of the economy to monetary policy actions, taking into account historical experience and the various estimates of timing relationships provided in economic research, as well as the high degree of uncertainty involved in applying the evidence on lags to the current situation. What are they saying here? They're talking about the lags, and they're saying, well, you know, we have past experience, we have economic research, and we're aware that this is really uncertain stuff that we're dealing in. dealing with. So they're looking at how long the lag would be. I think this is a revealing statement that we get as well. The tightening of monetary policy had clearly influenced financial conditions, had notable effects in some interest rate sensitive sectors. The timing of the effects on overall economic activity, the labor market, and inflation was still quite uncertain, with the full extent of the effects yet to be realized. And then finally, the historical record did not provide definitive evidence on the length of these lags. So we say it works with a lag, and you hear certain numbers thrown out. And they have a discussion on this, and they conclude that, you know what, we got no clue. We got no clue. The historical record does not provide definitive evidence of the length of these lags. In other words, somebody's saying, we don't have a clue. I mean, we're making this stuff up as we go. We don't know. Some participants noted that the risk that energy prices could rise sharply again amid geopolitical tensions. Yes, that is still a threat. If energy prices rise, what else rises? Transportation costs rise. Energy prices rise, that squeezes out purchasing that consumers can do in other areas as well. We haven't really hit winter yet. Natural gas prices are still elevated. Energy prices are still elevated. Although they're coming down, they're still elevated. That's going to squeeze out purchases in other sectors. A few participants commented that the ongoing tightness in the labor market could lead to an emergence of a wage price spiral, even though one had not yet developed. I don't know if that's true. You've had 2 years of this now, and I know that within the organization that we have, I know that there are some people that are anticipating a wage increase for no other reason than inflation. Not because they're better, not because they have a year of experience, but there's a certain component of their increase that they're expecting only because of inflation. That's a wage price spiral. Risks regarding, well, I shouldn't say it's a wage price spiral. It's the beginning of a wage price spiral, because then it's up to the company to say, well, if we're giving everybody a raise because of inflation and not because of their experience, well, we're going to have to pass that extra increase in wages on to the market, because the increase in wages you give because of inflation is not because they're more productive because they have a year more experience. Usually when you pay somebody more per year, it's because they have a year more experience and they're more productive. So that even though you're paying them more, your unit costs are still either stable or dropping. But when you add a high level of inflation to that, a price increase just due to high level of inflation, that price increase overcomes the amount of increased productivity that they may have, leading to higher unit costs. So you would have no choice but to raise prices. That's the wage price spiral. Risks regarding the outlook for economic activity were weighed to the downside with various global headwinds. They name a few: a slowdown in economic activity occurring in China, the ongoing international economic implications of Russia's war against Ukraine, monetary policy tightening was underway in many other economies, the potential for spillovers to the U.S. economy. So they note that that exists. Participants observed that despite elevated interest rate volatility, which has been coming down quite significantly, by the way, and indications of strained liquidity conditions, the functioning of the Treasury security market had been orderly. So even though we hear a lot of talk about liquidity drying up in the Treasury market, they're saying, no, not really. So don't look for them to stop QT because we think that there's a liquidity problem in the Treasury market. This is them saying, it's orderly. We're not going to stop anything. Hey, listen, we're almost done here. Okay, here we are. With realized inflation well above the goal and the labor market still very tight, participants agreed that ongoing increases in the target range for the federal funds rate would be appropriate and would help keep longer-term inflation expectations well anchored. And there's the work again on inflation expectations. In discussing potential policy actions at upcoming meetings, big paragraph here, participants reaffirmed their strong commitment to returning inflation to the committee's 2% objective, and they continue to anticipate that ongoing increase in the target range for the federal funds rate would be appropriate. Ongoing increases in the target range for the funds rate would be appropriate in order to maintain a sufficiently restrictive stance of policy to bring inflation down over time. Their assessment of the ultimate level of the federal funds rate that would be necessary to achieve the committee's goals was somewhat higher than they had previously expected. There is the higher that I alluded to earlier. They are acknowledging that, hey, we thought we would go to this level. We got to go higher than that level. Participants mentioned a number of considerations that would likely influence the pace of future increases in the target range for the federal funds rate. Now it's getting interesting, right? When you read for so long, you end up, with difficulty pronouncing words. The cumulative tightening of monetary policy to date, the lags between monetary policy actions and the behavior of economic activity and inflation, and economic and financial developments. So I think this is a clear paragraph that they are signaling that we're slowing down here. As monetary policy approaches a stance that was sufficiently restrictive to achieve the committee's goal, it would become appropriate to not stop, slow the pace of increases in the target range for the federal funds rate. A substantial majority of participants judged that a slowing in the pace of increases would likely soon be appropriate. And we will see that in December. A few other participants noted that before slowing the pace of policy rate increases, it could be advantageous to wait until the stance of policy was more clearly in restrictive territory and there were more concrete signs that inflation pressures were receding significantly. So some are saying, well, yeah, we need to slow it down, but why don't we, get to where we want to go fast and then we'll slow it down. With monetary policy approaching a sufficiently restrictive stance, they're already saying that we are approaching that stance. Participants emphasized that the level to which the committee ultimately raised the target range for the federal funds rate and the evolution of policy stance thereafter had become more important considerations for achieving the committee's goal than the pace of further increases in the target range. We got that message very clear in the press conference after that we should stop paying attention to the pace of increases. That's going to change, but we should be more concerned about the ultimate level and for how long we're going to be there. That they're trying to shift attention to that instead of the pace so that they can slow down the pace without causing a big market rally. Well, I think too late on that one, right? Participants agreed that communicating this distinction to the public was important in order to reinforce the committee's strong commitment to returning inflation to 2% objective, and communicate that they did. One more paragraph here, and then we get to committee policy action, and what you see on the screen is all we got. Some participants observed that there had been an increase in the risk that the cumulative policy restraint would exceed what was required to bring inflation back to 2%. So some are saying, maybe we've done too much. Several participants commented that continued rapid policy tightening increased the risk of instability or dislocations in the financial system. Well, it does. It does increase the risk. But, the risk of something going from 1% to 3% is still an acceptable risk. But, yeah, it's an obvious statement to say it is increasing the risk. There was wide agreement that heightened uncertainty regarding the outlooks for both inflation and real activity underscored the importance of taking into account the cumulative tightening of monetary policy, the lags with which monetary policy affected economic activity and inflation, and economic and financial developments. Just a repeat of what we saw earlier. Okay, with all of that behind them, now they're ready to make their decision. Recent indicators had pointed to modest growth in spending and production. Job gains had been robust in recent months and the unemployment rate had remained low. Inflation had remained elevated. That's the summation of everything. I probably could have just read that. The too long didn't read. There it is right there. Members concurred that they remained highly attentive to inflation risks. Members anticipated that ongoing increases in the target range would be appropriate in order to attain a stance of monetary policy sufficiently restrictive to return inflation to 2% over time. Members agreed that, in determining the pace of future increases in the target range, they would take into account the cumulative tightening of monetary policy, the lags with which monetary policy affected economic activity, inflation, and economic and financial conditions. We get the message, right? All members affirmed they were strongly committed to returning inflation to its 2% objective. And then, of course, you have the vote, and all of these bullet points is what they voted on getting done. And there it is. So we know what they're looking at. We know what they're seeing. They have clearly, in this one, big takeaway, they have clearly communicated that these 75 basis point rate hikes, yeah, they're pretty much in the rear view mirror. We're going to step down to 50. No one thinks they're going to go 75. Although you get CPI on December 13th that is ugly, they could go 75. But if it follows suit and it pulls back a little bit more, yeah, they could go 50. And if the December CPI comes down from the November CPI, then I don't know how they're going to contain financial market conditions stemming from a rally in equity markets, because that is what would happen. And then I think at that point, the whole Fed discussion will also be rear view mirror, and what will be in front of us, the primary discussion in front of us, are earnings and recession. But if you get a soft read December 13th, you get 50 basis points in December with a press conference that acknowledges that you've had inflation moving in the right direction, you're rallying into the end of the year.